Hey there. Hope you're having a good day so far. First off, I really want to thank you for accommodating to my schedule. I've been chock full of meetings lately, and they've been eating up a lot of my time. So I'm really glad we could actually carve out the time to sit down for this one-on-one. As I recall, though, you came to me since you had a general idea of how we go about investing and just going about stocks and bonds here at the company. But you did have some specific questions, and I think I can help clear some of those up. So, first off, I do recall that you mentioned you essentially wanted to figure out how our company makes money from stocks and bonds. So, stocks and bonds are two very different financial classes. Stocks are essentially equity in a company. Whenever you purchase a share or a stock in a company, you essentially own part of that company and get to reap their profits. You get to technically have a say in the decisions. Obviously, though, having one share of a company doesn't really give you the voting rights of the institutional powers that be or whatever. But yeah, so having a stock in a company is essentially ownership of a part of that company. If the company is worth $100 million and there are 100 million shares outstanding, you get the $100 million valuation of the company divided by the 100 million shares, and you own $1 of the company essentially. Along with that, you own 1 over 100 millionth of that company, which is to say a negligible amount, but an amount nonetheless, which I always found pretty cool, honestly, that like everybody was able to be part of those, super big companies, especially with the tech giant like us in the industry. Bonds, on the other hand, are kind of like a loan. Think of it like you can take a personal loan out from the bank will charge you interest over time, and you got to pay back the principal and the interest date by a certain time. The only difference is that we invest heavily in corporate bonds. Now, the beauty of these is basically we just give a company, say, like $100,000, and they will tell us, okay, we can give you 5% on this. Semi-annually, we'll pay you out, and we will have your money back to you 10 years from now. The thing about that is that while we may not get our $100,000 investment back till 10 years from now, we will get that 5% interest annually. So essentially, if we have 10 years on that bond, and 5% of our 100,000 is $5,000, they will pay us $5,000 a year. Since they're paying us semi-annually, we'll be getting $2,500 every 6 months. So if you think about that, that's $2,500 every 6 months, pretty much completely for free for 10 years. And then as soon as those 10 years are over, they'll give us our $100,000 back. So over that period of time, you've accumulated $50,000 in interest over the period of 10 years. You'll get your $100,000 back, netting you an overall 50% gain. Not bad, and it's pretty stable, to be honest. I do remember also that you wanted me to explain the forms of dividends to you, and more specifically, what kind of dividends the company sees from corporations. And I love to use paper. I know we obviously just like take it for granted. We use it day to day in pretty much everything that we do. But paper really helps with this. So I want you to visualize this kind of as like the profit that any given company makes, a dividend issuing company makes. So out of all of these profits, they will have a certain number of shareholders they have to pay dividends to, and they will pay a certain amount of dividend per share. Now, the one I'm going to focus on primarily is a cash dividend. Companies also issue stocks and property dividends, and they rarely issue scrip or liquidation dividends, so I'm not going to go into those two, but stock dividends are essentially that, hey, you've owned this stock for the amount of time when we're going to start giving dividends. So for your dividend, we're going to reward your stock with more stock. And that's pretty cool. They're rewarding you for owning part of the company with more part of the company. Property dividends are essentially any sort of property that the company owns, whether that can be like collector's artwork, whether that can be rare metals, whether that can be actual land. And they will pay a set amount to every single investor. Typically, property dividends go out to smaller companies with like limited amount of investors, but cash is by far the most common type of dividend. So let's go back to the example I had. Think of this sheet of paper as kind of like all of the company's profits. For each shareholder, they will take a tiny bit of the profits and give it to the shareholder. Shareholder number 2, same amount of profits. Number 3, same amount, until they paid out all the shareholders, and let's just say that this amount is how much they pay the shareholders, right? So this is all the dividend stuff. They're left with this many profits. Now you're going to think, why would they give out so much of their profit to just the ordinary stock investor? But the thing is, this is very incentivizing for people to buy the stock. Stock dividends or cash dividends on stocks can range from anywhere to 0, which a lot of companies do, to the higher end of like 14 to 15% on publicly traded companies. It's a very good investment, and it's a very stable investment because you know for a fact you're gonna get a guaranteed return on your investment. Whether the company goes up, whether the company value goes down, you will get your cash dividend and you will be paid the amount that you were promised. And that's the beauty of it. That's the beauty of dividends. And we typically invest in corporations heavily that do have high dividend yields, and we generate quite a bit of stable revenue from that. I also understand that you wanted to learn how to calculate the interest on a certain type of bond, and you gave the example of a $500,000 par value with 5% stated interest and semi-annual payment with maturity in 20 years. Okay, so here's a really cool trick that I learned. Believe it or not, if you just take 5% of however much that par value would be, so like the interest rate percent of how much that par value is, so we're giving them $500,000, and we get 5% of that annually, right? So 5% of 500,000 is just 500K divided by 20, which is going to be $2,500, or $25,000 annually, my bad. Since they're paying us semi-annually, we'll be getting $12,500 every 6 months from the company for 20 years. So since we're getting $25,000 every single year for those 20 years, we will get $500,000 in interest, and then after those 20 years, we'll get our $500,000 original principal payment back, yielding us $1 million. If you found this bond, thank you so much for bringing it to me, because a 100% yield bond is technically phenomenal. I mean, even if it's 5% a year, it's a pretty stable investment. It's a pretty good yield, and if you can just get me the company financials, I'll definitely forward that to my boss and obviously say it's from you, so great find. But yeah, so a $500,000 par value with 5% interest means $25,000 a year, $12,500 every 6 months, and overall we'll get $1 million back at the end of our 20-year period for investment. You also want to know in regards to what exactly is the less risky investment between stocks and bonds. And this is kind of a gray area if you think about it, because both have their merits for sure. Stocks that are paying dividends are oftentimes more stable, but I would have to personally say bonds. And that's only for the reason that it's over time, it's a strict cash payment regardless of how the stock performs. If the stock goes down more than the dividend percent is worth, for example, if the company is issuing 10% of a dividend per year, but then their stock drops 15%, we still get a 5% loss. Whereas for bonds, if we give them $100,000 and they're giving us 5% interest annually, and that's going on for 10 years, that's guaranteed money. Obviously, unless the company goes bankrupt or liquidates, but we've got a great team of legal experts and financial analysts on that, so not too stressed about that. But typically, the less risky investment is almost always going to be bonds, especially of the corporate sort. Now, T-bills, treasury bills, are also a type of bond issued by the government. Phenomenally stable, you can't go wrong. But the interest rates are a lot lower than corporate bonds, so it's kind of all just a mix of what your profit incentive is versus what your risk appetite is. But overall, bonds are going to be the less risky investment. And finally, you want to talk about kind of what a stock split is. I'm going to bring out my handy dandy paper again. So let's assume that a company overall has 20 shares, right? Just for simplicity's sake. So we've got 20 squares here detailing exactly one share per, or one square per share of the company. Right, so let's go back to the issue of like where somebody owns stock. If you own stock in the company, if you own a share of the company, this stock is yours. This share is yours. You technically own 5% of the company because you own one share out of the 20 in the company. Now, if you were to own 2 shares, you would have 2 squares and then own 10% of the company. What a stock split essentially is whenever a company is motivated to split their shares into, like, say, from 1 to 2 shares in regards to the price becoming too high for the industry or just to increase liquidity. So say that the overall price of the company is way too high for the industry, or like the average price of the stock is way too high for the industry. The stock will essentially split into a certain amount. This is a 2-to-1 split where one share turns into 2 shares. The price of the actual stock is going to halve, but the thing is that the value of the company remains the same. So this sheet that was originally 20 squares will become 40 squares, but the value of the company will be the exact same. I do think that that was all of your questions. Hopefully I answered them with a degree of clarity. If you have anything more though, please do reach out to me. And yeah, I really appreciate you having you here. You have any questions for me?